You're such an asshole.
AssholeConsulting.com, we got a good question here. Hi Aaron, I hope you are well. I want to let you know your previous video has helped me overcome the situation I've endured, and that during the interim I've received a substantial raise and am well on my way to receiving my appraisal license. However, I am emailing you because I want to get your opinion on a subject I've been researching during my time off. Over the last year and a half, I have read Securities Analysis and The Intelligent Investor by Benjamin Graham numerous times. Numerous Securities Analysis multiple times. That's not even as boring. That's more boring than Atlas Shrugged. And there's no villain in that one either. That's you got to get out, pal. His formulas and views on investing make sense to me. However, I was wondering if you could do a video on how applicable his approach is given the current market conditions and its future prospects. I am aware that most of the large indices have reached all-time highs, and the Shiller PE ratio is at 29, which would mean that securities are very expensive relative to earnings and almost double the historical average of 15. At least according to the chart I looked at, the only times that has happened was in 1929 before the Great Depression and 2000 before the dot-com crash, which seems ominous. I would appreciate your input on Graham's approach given all the changes that have occurred with respect to computer formulas that invest automatically, ETFs, mutual funds, high-frequency trading, low to negative interest rates, and the current economic global malaise. Thank you, and please let me know if my question is unclear. I know I touched on a lot towards the end there. No, it's perfectly clear because you're absolutely 100% right. You know what's going on. I know what's going on. Schiff and Schiller know what's going on. And anybody with their heads out of their asses know what is going on. But, I mean, damned if the American population just doesn't love their asset bubbles. They just love bubbles. Housing bubbles, dot-com bubbles, stock bubbles, education bubbles. They just love bubbles. They can't wait to pay, in the case of the PE ratio, which you're familiar with, twice, essentially. It's like paying $10 for a Big Mac. But they can't wait to do it because the stocks go up, housing goes up, yay! So let's answer your question. Is Benjamin Graham and what would be otherwise called fundamental analysis, that technique, correct? Yes. Benjamin Graham and under the larger guise of fundamental analysis, the CAPM model, not to bore you, that is all correct and precise. That is what the value of a stock is. Okay, you take its cash flows, you account for risk, you discount it to today. That is what the value of a stock should be. And his analysis, looking at debt ratios, looking at profitability ratios, looking at growth, looking at your cost of capital, it's all 100. It's very mathematical, very literal. The problem is it's in laboratory conditions. And we can't even say laboratory because that indicates pristine. That's just normally functioning conditions. We are not in normally functioning conditions. And so what's happening is, whereas we looked at the, say, supply side of stocks. Stocks supply what? They supply profits. That is what drives the price. Okay, technically dividends, but I'm not going to get into the boring details. Stocks supply profits. And if a stock were to supply twice the amount of profits, then its price should go up. It should double. You know, I'm at the meat counter. I get a pound of hamburger. It costs X. If I get 2 pounds of hamburger, it should be 2 times X. However, we are now looking at the demand side of the equation. So there's supply and then there's demand. Demand has become all fucked up for the reasons you highlight here. Where do we start? Computer formulas that automatically invest, ETFs, mutual fund, high-frequency trading, low to negative interest rates, the current global economic malaise, and you forgot retirement plans, 401ks, 403bs, IRAs, stuff like that. And what we have happened for various reasons, all highlighted there, is we have drastically increased the means by which people can purchase stocks and bonds. We've also given them tax incentives to buy stocks with 401ks and IRAs. And this has flooded the stock market with money, the trillions, literally multiple trillions of dollars that would not have been there. Tens of trillions if you go back to 1978 when we started having 401ks. Right? So what has happened is that it is no longer the underlying profits. It is no longer the fundamentals and fundamental analysis, Benjamin Graham's analysis, that is driving stocks. That's the supply side. It is the demand side. And that for multiple reasons, again highlighted there, all these factors have been given a shot of steroids and testosterone, and now everyone wants to buy it. So you have your low interest rates, right? What was it? I'd have to look at David Stockman wrote a great book. I forget the name of it, but he measured it, and this was several years ago. He measured it like they're almost up to $1 trillion. Several years ago, they're up to $1 trillion in corporate buybacks. Why? Because interest rates are so low. Corporations look like, well, we could go borrow this money and start a new factory, or we could just buy back our stock and get a much higher and risk-free rate of return. So a lot of corporations have borrowed money at lower negative, not negative, but very low interest rates and bought back their shares. The 401ks, IRAs, retirement plans with those tax incentives, people have been incentivized to invest money they otherwise wouldn't have. And I don't know why we ordained the stock market as the default retirement vehicle for Americans' retirement plans, but we have. And so that has flooded the market. Again, no one, what person investing in their IRA or 401k even looks at PE ratios? How many of them do fundamental? How many of them read The Intelligent Investor? None of them.
It's like, the HR lady said I should invest in a 401k. Okay, I have it on automatic monthly deduction. That way I just don't think about it.
Yeah, key thing, you don't think about it.
I just pay whatever the market tells me.
And then also an issue of liquidity, which you've talked about here. Online trading, high-frequency computer trading, mutual funds and ETFs have allowed for people to diversify much more efficiently. All these different financial products that have hit the market just makes it easier. It's like a credit card. Before credit cards, you had to actually pay cash or pay in a check. So it was a pain in the ass to pay. Also, when credit cards come up, whoa, hey, look at how much more spending, because it's just physically easier. Kind of like PayPal. It's just easier and thank God, because I make money through PayPal. It just makes it much easier for people to buy. So all these things, the liquidity, and then just printing off the fucking money. I mean, inevitably, finance companies weren't allowed to buy stocks and bonds. Yeah, but inevitably when they borrow at dirt cheap interest rates and there's a bunch of cash washing the economy and no one's investing, the economy's not growing. It's like, what should we do? Let's park our money in the stock market. Why? Because it's safe. And maybe not so much U.S. corporations, although they are buying back their own shares, but not just corporations, foreign investors in foreign countries, for fuck's sakes. Foreign central banks are buying U.S. dollar-denominated assets. I mean, not the central banks buying U.S. stocks, but certainly foreign investors are looking at the U.S. dollar in the U.S. as a safe haven. You look at the debt problems that China has now, that's certainly driving up demand for U.S. stocks. So there has been a decoupling, a break between the fundamentals of what a stock is really worth and what is driving demand for it. People no longer buy stocks for a rate of return. They buy it because of pretty much any other reason. We got nothing better to do with our money. I don't want to lose against inflation. My HR lady told me so.
Jesus loves me, this I know. Invest in the 401k, the HR lady told me so.
What other although this is more advances in technology, I would say, which are permanent, therefore it would legitimize an increase in the overall PE ratio, would be the financial products that increase liquidity, online trading as well, some services. But that has driven up prices well beyond what the earnings and the underlying dividends of these stocks provide. So what's sad is, Benjamin Graham and his books and fundamental analysis in general is obsolete. You will be a better analyst analyzing the economy and central banking policy and corruption rates overseas and looking, where are the international cash flows going? Focusing on that demand side, than you will the actual stocks. And so it is a bubble, you could say, when is it going to burst? Don't know, because I'm a real economist. I'll admit I don't know when that's going to happen. But yeah, you're absolutely right. The PE ratio is twice of what we pay twice the price now for stocks than we used to. I love it when people say, there's no inflation. See, Obama, he did everything fine, there's no inflation. It's like stock prices literally, they almost tripled since the crash. Housing prices doubled. Everyone's happy they're paying so much fucking money. And then there's education and healthcare. There's plenty of inflation all around. We just turn a blind eye. Is gas up? Did I pay more for a Pepsi? No, then there's no inflation. But yeah, there is no, and it's kind of funny, like the schools, the colleges and finance majors especially, they'll teach you discounted cash flow, they'll teach you fundamental analysis. It's fucking pointless now. It's complete. It's good to know how to analyze a stock, because I would still say in private investments that are not publicly traded and don't have access to public markets and all this fucking money flooding it, those you could still like use to analyze. And plus it's good to be able to read a financial statement and do your taxes, read a tax return, stuff like that. But no, you're absolutely 100% right. Benjamin Graham is obsolete. They're really, unless we're to have a true crushing recession that would reset prices back to where they should be based on the cash flows of a company and not a hyperinflated, over money printed market and economy, I would frankly not even, don't read it a third time, okay? Don't read it a third time. Go chase some girls, play with some boobies. Don't read Securities Analysis a third time, all right? Because it's legitimate, it's real, it is what it should be, it's the laws of physics, it's just that no one's obeying it anymore. It's all economics, and everything but the company is determining the price of the company. So anyway, sorry you didn't, I don't want to say you didn't waste your time. You didn't, because it is really good to have that financial acumen, but yeah, don't keep going down that road. It's predicting the actions of everybody else and taking your focus off of the company. That's going to help you predict asset prices. You guys got questions, go to assholeconsulting.com. And you can read my books. You can find them on Amazon.com. It's all great, super awesome economic genius. We'll see you kids later. Toodles.